Hey dividend investors, today I am going to talk to you about the Enhanced Income ETFs by Horizon. Now really quickly, I do want to mention that these are all covered call strategies which do give you generally more yield than regular stocks alone. So let's get down and let's check out some of the Horizon Enhanced Income ETFs. So this first one is HEF. It currently at the time of recording this video is trading at $8.07 per share. It is traded on the Toronto Stock Exchange and its average trading volume is 4,100 shares per day on average. Now from there, what do we really want to look at? Well, we want to really look at is the actual distribution and how much they are paying, and generally speaking, because their dividend is not the exact same every single month, similar to BMO. These ones tend to be changing within a penny's range every single month. And from there, the 12-month trailing yield I will go by instead of the current yield, which is 6%. And it is paid monthly, which is beautiful. Now from there, the record date you would have to own this ETF by is one of the last few trading days of the day, or of the month I mean, and then you would get your dividend the next following month. Now as we can see, the actual dividend does change every single month. Not by a lot, but it does change by a bit. Now, considering that this is a covered call strategy, I would really want it to be a higher than 6% yield, but at the same time, 6% is still extremely high for any investment. So for HEF, the holdings are all financials. It is the financial version of their enhanced income, and their biggest holdings are Bank of Nova Scotia, BNS, Manulife, as well as Bank of Nova Scotia and Bank of Montreal, and Toronto Dominion Bank, TD. From there, they start to really trail off quickly, but still all in the financial or insurance sector. Now, I personally feel that this has been a sector that has been hit quite hard recently because of the pandemic, and I think that this will be a longer drawn out recovery over the next year to 2 years, depending on what happens with inflation. Now, we have to remember with the banks, that generally with banks, they make more money when the interest rates are higher. But if the interest rates get too high, that's when the mortgages, car loans, and things like that tend to not work. They tend to then start losing money because their loans are now void. So, bankruptcies and things like that. So that is a fine line. You want interest rates to be high, but at the same time not high enough to just destroy the economy. But this all is going down to how much money the government is printing as well. Because if the government has printed so much money, it gets thrown into the marketplace. And I don't mean stock market. I mean buying and selling things, the consumer market. If it gets put into the consumer market, basically what's going to happen is the interest rates are going to go super high, which is going to create an issue later on down the road when it comes to a market crash. And anytime there's a market crash, of course, the banks will get hit first, as we've seen with the coronavirus pandemic. And when it comes to their chart, it generally kind of moves within a range, right? So they generally move between $7.50 and $9.50 per share. At the point it's at now, it's at the bottom of the trading range that it normally trades within over the last roughly 8 years. And from there, I would assume that this would be a good hold over the next year to 2 years while it goes up to $9.50. You then get yourself roughly a 30% increase in your underlying equity, plus you're getting a 6% dividend. But once it starts getting close to that $9.50 range, I would start pulling my money out and investing in other things, because we have seen that it has really not done too well to try and get past that $9.50 range. Of course, past performance is never a promise on what happens in the future, but generally speaking in ETFs, you can kind of see where they're going. The MER is going to be quite high when it comes to ETFs, but the expense ratio, the MER, is 0.65%, which is generally in line with the roughly 0.7 that most covered call ETF strategies have. Something that is quite interesting to me is the fact that Yahoo's volume is lower than what Horizon says their volume is. Next is going to be HEE, and it currently trades at $6.38 per share at the time of recording this video. They say that the volume average is 6,661 shares per day. 666 might be a bad sign, but either way. From there, what we are looking at is an inception date of 2011, so it's been around for quite a long time. The 12-month trailing yield is, I'm going to say 5%. I'm not going to get nitpicky on that one. And the expense ratio is 0.85. It does hold energy holdings. It is an energy ETF. This one, again, is a covered call strategy, and it holds some of the bigger names in the oil and energy industry. And when it comes to the energy industry, I'm going to tell you right now, I think oil is going to go back up to $100 a barrel and even higher, because we have Trudeau in Canada and we have Biden in the United States, both of which generally dislike oil, and they will probably try and close down as many oil plants and oil fields as they can. And of course, when that happens, of course, it's going to hit jobs, but number one, it's going to be really raising the oil price, because if there's less oil being sold, then there's a higher demand for oil. And when that happens, oil prices go up, and that means that the underlying companies that mine oil also go up. So there's my thought on why this one might be a good option. Now, just like HEF, the dividend is not the exact same every single month, but it's generally roughly hovering around that 2-cent-ish per share. And of course, earlier on, before the pandemic, it was getting roughly just over 3 cents per share. Now, this is what I mean by watching out for different stocks or different ETFs that have the covered call strategy. As we can see here, it is a downward trend ever since the inception. And is this good? Well, let's face it. The inception was 2011 and oil prices were quite high. Oil prices have gone down since then, so this could be an interesting time to buy because it could ramp back up because of what's happening in the United States. However, at the same time, as soon as Trump got in, it really decided to start tanking, and it just kept on going. Now, this is not a good start from here to here, but basically saying that I think that oil could go back up, but again, in a lot of covered call strategies, this is how the charts look. So this is why when it comes to covered call strategies, you always want to look at the chart, because of course, if they are paying your dividend out of your initial investment, then there's an issue. And that's what it does tend to seem like when it comes to a chart like this. HEX is also another interesting option. So HEX is another covered call strategy ETF. And at the time of making this video, it's $6.16 a share and currently pays 5.33% of an interest. I mean dividends. But from there, what we want to look at now is what does it hold? What's its distribution? Its holdings are interesting. Basically, you're going from tech stocks all the way to bank stocks. It's kind of a mixture of all of them. And of course, its largest holdings are going to be basic material stocks, energy and financial institutions, and technology. When you start looking at the dividend, again, not like BMO where the dividend stays the exact same cent-wise or increases. It's generally bouncing between a couple of decimal points when it comes to a penny. This one again has also been around for some time, and it has had a little bit of a decrease. Of course, from the beginning to here, it did not do very well. It was going down. Then it sort of stabilized, and then of course the pandemic hit and has rose since then. So how I would personally play this is if you think it's going to go back up to that $7 range, then of course you could play it and get a good dividend. But personally, with a chart like this, if you're looking for a long-term solution, I would not be picking this. So in conclusion, I am not a massive fan of the income strategy for the Horizons ETFs. There are some ETFs that I do like from Horizon, like HMMJ, which is a marijuana ETF. And you can, of course, go find out my video on HMMJ on this channel. So make sure to go check that out if you're interested. It does pay a dividend, which is interesting from short interest, essentially. But, of course, I hope that you have enjoyed today's video. If you have, hit that like button and subscribe, and I will see you guys again next time.